Let's move on to HSBC, which is a British multinational banking and financial services company headquartered in London.
Indeed, headquartered in London, but in fact it only moved its head office there in like 1991. Why did it do that? It's because it prepared for the transition in Hong Kong. Its original origins, as you can imagine, with a name like HSBC, which stands for Hong Kong and Shanghai Banking Corporation, was indeed in Asia in the 1860s, and then it brought its head office back in preparation for that transition.
And they've just undergone a huge review in terms of whether that headquarters should remain in London or not. It comes back to the point that we made earlier on the regulatory environment, the stringent regulation in the UK market, and further the costs of operating a head office in that territory.
Indeed, so it's got its head office in Canary Wharf, but with something like 75% of its profits in fact coming from Asia, you've got to wonder whether it wouldn't be more appropriate to have that back in Hong Kong where it was before.
Market cap $186 billion, trades on a PE of 14.5, dividend yield here, we're talking about 5.2%. So this is certainly the best dividend payer of the three that we've just chatted about.
It's been through some turmoil, so it's had quite a few senior executive changes. So currently Stuart Gulliver, who's the CEO, has come to the fore after quite a few chops and changes and resignations as a function of some of the regulatory risks that it faced, because it was fingered by regulatory authorities for having been involved with certain breaches of confidence in relation to its private wealth business in Switzerland, but also trading of forex in the UK, etc., where, you know, at the end of the day, the cost of the fines as well as the reputational risk is reflected in the bank rating.
Right, so let's look at the performance of this one versus what we've seen on the JP Morgan side and the Wells Fargo side. Let's start with the share price reflection.
There you go. So that's what a 5-year share chart looks like, where you've had serial disappointments, upsets with regard to sizable fines, the European, the regulatory risk, the generally fairly negative environment in the UK with regard to banks and their activities. And the idea that some of the most profitable parts of the business, like forex trading and so on, are going to get curtailed and much more carefully monitored, leading to lower profits in those divisions.
So where does that leave the investment story here? Are you still concerned? You say that they are starting to look a little better.
In my investigations of what stocks to buy, HSBC certainly screened well, because Asia has got to be an exciting environment to be based and to have significant
especially
roots.
From a banking perspective with the consumer base.
And so we looked at the Chinese banks, because of course one can buy things like ICBC and that sort of thing. We generally felt that they were not as attractive from a corporate governance and visibility and transparency point of view, and also given the nature of regulation of the financial sector in China, potentially also, you know, there could be a decision out of Beijing which changes the basic fundamentals. So Hong Kong Shanghai Banking Corporation looked quite good, but with that backtrack record, we just thought maybe it wasn't quite as attractive, has a bit more work to do.
So you couldn't quite get to the buy decision on this one, on HSBC?
Indeed. So I would say it's hot. I'm going to give it the benefit of the doubt because it made the final, you know, kind of beauty parade list, but certainly not quite as attractive as the others. And
you're going to adopt a wait-and-see strategy on this one?
But it certainly has its attractions, given that it could well bounce back. It could benefit from lower costs. I mean, they are cutting salaries and cutting, not salaries typically in the banking sector, everyone's well paid there, but cutting the number of employees in some of their key operations.